Welcome to the Tepper School of Business Multimedia Series. For more information on the Tepper School at Carnegie Mellon, please visit us at www.tepper.cmu.edu/multimedia. And now, here's your selected video.
And for those of you who have not met Professor Spatt, he is the Kenneth B. and Pamela Dunn Professor in Finance here at Tepper, and he's also the director for the Center of Financial Markets here at Tepper. He's internationally known about his research in financial markets, and he also served as a chief economist and director for the Office of Economic Analysis at the U.S. Securities and Exchange Commission. So we had lost Professor Spatt for a couple years, but we were very happy when he returned back to Tepper, and he teaches quite a few financial electives that you'll have an opportunity to take. Turn it over to Professor Spatt.
Great. Thanks, Wendy. To follow up on that last point, in the spring I'll be teaching electives on financial regulation, which will be kind of maybe most directly related to this today, and also on fixed income and taxation. So my subject today is the G-20, which, as all of you know, is going to be in Pittsburgh in a few weeks. And I thought maybe a good place to begin, before I get to the substantive aspects, is why Pittsburgh. This has actually been the subject of a lot of attention in the media in recent weeks, and I think increasing interest by reporters as folks realize that hosting the G20 isn't exactly a free good. And so how did this kind of come about? Let me just point to a few factors. So first of all, as many of you know, traditionally Pennsylvania has been a so-called swing state. In presidential elections, it sort of voted for both parties. In the United States Senate, it certainly had representation, and the governorship as well. A lot of these positions have been sort of rotated between the parties. Pennsylvania is also near the District of Columbia. Now, why do I mention that? Well, because I think the White House has indicated that the president won't be sleeping in town. Apparently, he's planning to sleep at the White House. Now, why do I mention that? Well, 20 plus years ago, there was this company in town called Allegheny International. And Allegheny International actually owned a very nice house within a mile or so of here. That was at the time, about $1 million house. And there was a big issue involving agency and moral hazard and Allegheny International's corporate governance and some of the ways in which they were spending money. And at this point, Allegheny International, when they were asked to defend why do they own a house, they said, well, there wasn't a hotel in town that was good enough for their guests, for their corporate guests. And maybe the president, he feels the same. So the distance kind of plays into this. Clearly, the local political leadership in town was very supportive of this effort, and that was certainly crucial. Because, in fact, the rumors certainly have flown over recent weeks as folks have become more agitated about all the dislocation, that a number of other cities, including rumors, the president's own home city of Chicago, in fact turned down the opportunity. This opportunity. The local political leadership, on the other hand, I think viewed this as an opportunity, as I put it in the slide, to market the burg, to market the city. But I don't know. What the imports of that are is sort of not that clear cut. There are other kind of marketing opportunities too. In fact, we see one this evening where Pittsburgh is going to be on national television with the opening of the NFL season, and whether the publicity associated with all the demonstrations that are going to expected to be in town 2 weeks from now, how this sort of plays out. This all remains to be seen. So there's certainly been an emerging curiosity about which locales declined, I think in part because of issues of out-of-pocket costs, congestion. We've heard about closures of schools and businesses. Even the banks in town have called some of their customers to say, well, if you need to do certain activities on these days, we're not going to really be able to help you. And the experiences both in Seattle, where it was at that time it wasn't called the G20, I think it was called the G7 or the G8. Certainly the experiences in Seattle and London were kind of mixed bags. In fact, as an economist, it leads me to ask the question, who would be the low-cost provider? Who would be the efficient provider of these services? Not clear to me whether it would be Pittsburgh. In fact, in my mind, it would be someplace like Sea Island, Georgia. Why? because Sea Island is a really isolated place. And so the Secret Service, they have their security concerns. Well, basically, there's one road in. And you know what? The Secret Service, they could secure that pretty easily, especially with the 4,000 police that they're bringing in to reinforce the city of Pittsburgh police. Anyway, that's some just issues about Pittsburgh. Well, let me talk now about the substantive issues that the G20 will take up. I'm going to focus on economics and specifically the macroeconomy and the financial markets. That's not the only thing the G20 will talk about. They're going to talk as well, I think, to some degree about green issues and energy issues, it's environmental sustainability, et cetera. But a lot of the focus is certainly going to be on economics and the financial markets. So I think as a prelude to that, perhaps it's helpful to first talk about, so why is this crisis? Why is it so global? After all, most people think its roots were in the subprime housing finance mess in the U.S. So how did this quite quickly become a worldwide crisis? Well, I think in part it reflects, to use a cliche, it reflects the globalized nature of our overall economy. And indeed, economics really emphasizes the importance of trade and comparative advantage and specialization. So there's a lot of trade, and that trade is certainly quite great in financial arrangements. Financial arrangements really are global. Indeed, if you look at some of the major players, the major British banks, the major German bank, Deutsche Bank, UBS, one of the major Swiss banks, these are global players. Obviously, Goldman Sachs, Morgan Stanley, the former Merrill Lynch, Lehman Brothers, Bear Stearns, these were global players as well. Furthermore, these businesses, they tend to have common practices. Now, that's not all that surprising. First of all, folks move from one firm to another. In addition, not only do they move from one firm to another, but they're trained in similar ways. Many of them are trained in programs like ours. And that sort of defined a lot of the approaches that the financial market participants have taken in recent years. The portfolios that are owned by these firms, they tend to be relatively global. That's in part because they're thinking about things from the point of view of arbitrage. And I use the term arbitrage not narrowly as sort of a finance professor might, but from a broader sense, that there's opportunities to invest in different countries and different contexts, and one is trading off the balance between that. And one is trading that off, whether one is a Swiss investor or a U.S. investor or a Japanese investor. And one is operating broadly on some of the same kinds of margins. Indeed, there's this integration of the financial markets, even though at the same time, there's another effect that's very familiar to in finance called the home country bias. It turns out that the portfolios of Americans are biased toward American assets. And similarly, the portfolios of Japanese are biased toward Japanese assets. But despite that, there's still tremendous integration in the markets, and as a result, lots of transmission across the markets. I think one of the questions that has fascinated me is, so why is the crisis so strong in Europe? After all, it was the subprime markets in the U.S. that were the cause, that were at the heart of the problem, that were maybe at the initial cause. And here I would point to two observations which are especially striking to me after trips that I had both at the start of the summer and also at the end of the summer to different parts of Europe. And that is that it seems that in Europe, there seems to be more adjustment remaining, and the problems seem to have been deeper, I think for two important reasons. First of all, if anything, the European banks and financial institutions had even greater leverage than in the United States. So, for example, UBS needed a $60 billion bailout by the Swiss government. Furthermore, if anything, the European financial system has been relatively less transparent. So it's been even more difficult in Europe than in the U.S. to figure out where all the buried bodies are, and this has had very dramatic import for asset pricing. I also should emphasize the importance of free trade. As we're talking about the G20 and the global economy, obviously trade, this is a absolutely central issue. And here I would point back to one very important economic idea. It's called the principle of comparative advantage. Basically, the principle of comparative advantage stresses that it's important, that it's valuable to specialize and produce goods where you have the greatest cost advantage or quality advantage, but where you have the greatest skill. And so, for example, one of the things that the United States has tremendous comparative advantage, as many of you recognize just by your attendance in our program, is actually in higher education. I think most observers think of the U.S. higher education as sort of second to none in the world, and I think it's a good example of comparative advantage. The importance of trade is, I think, also illustrated in a lot of the current discussion associated with exports. Countries are looking to other countries to help spur their growth. And this is really a striking aspect, I think, of a lot of the international conversation in recent months. The Chinese are the U.S. would like other countries to be stimulative, in part so that there's more demand for U.S. exports. Other countries are looking to the U.S. to be more stimulative. Yet at the same time, many countries have implemented what I would characterize as protectionist policies, and usually motivated by the desire to protect, and I'll put the word protect in quotes, jobs, to protect domestic jobs. And I think to some extent this can be a rather short-sighted view, what I would point out is the contrast between this view, which also is fashionable at least in some quarters, and the broad desire of countries to be able to increase their exports. In fact, at the recent North American summit, both Canada and the U.S. both Canada and Mexico pushed the United States pretty hard on this issue, pretty hard on the issue broadly of free trade. And in fact, I think arguably the United States has lost a lot of its moral leadership on the issue of free trade. I think personally that it's sort of an embarrassing situation that the Canadians, for example, are kind of lecturing us about the virtues of free trade. I kind of always sort of thought it was the Canadians who had their head in the sand on this issue. And one way that I would frame this is if we care about the welfare of the world, which I think many political leaders say that they do, we should be comfortable in supporting the aspirations of other countries. And that, I think, suggests not a very protectionist type of stand, and in fact, that we should be promoting trade. A little bit more on free trade. So I found it fascinating at Secretary Geithner's confirmation hearings, this goes back to January, where he was asked questions about China, and it was clear that in a departure from past policy, which obviously the new administration is allowed to do, he used language to suggest that the Chinese were manipulating their currency value by basically pegging it in the way that they did. And he used in particular very specific language, and it was clear that this was intended to send perhaps messages to two different audiences: one to the Chinese, that there was going to be a different policy on trade, and the other to pander to some congressman. Well, it's interesting what the response of the Chinese was to this. The response of the Chinese has been simply over the last 6 months, has simply to emphasize their perspective. And their perspective, of course, is as an investor in the U.S. and as an investor in U.S. Treasury bonds, and to express their concern in a number of ways about the size of U.S. budget deficits. And you know what? So what's good for the goose is good for the gander, as they say. And you know what? The U.S. now isn't talking so much about the Chinese manipulating the currency price. The other issue that I would also flag, a very specific factoid, was a byproduct of the TARP program. And I think this wasn't in the initial round of the TARP, but in sort of some of the legislation in the spring. And many of you are obviously going to be much more familiar with this than I because of firsthand knowledge. But the restriction that barred the TARP recipients from obtaining H-1B visas, and this is obviously of tremendous import and interest to business schools and business school students, because obviously those of you who are not U.S. citizens, which is probably about a third of you, this is obviously a meaty issue. And in fact, actually, to their credit, I think this issue more so than most was at the core of why the stronger financial services firms then have now figured out basically how to pay back the TARP. And actually, in that sense, maybe it was kind of a healthy development because it's probably kind of good that they're less on the taxpayer's dole. But nevertheless, I still see this in terms of kind of the issue of free trade and protectionism in a way. Fiscal policy. So one of the key issues in the G20 context are fiscal policy, and this was a big issue of disagreement in the spring in the April meeting in London. So the U.S. has been relatively aggressive in its approach to fiscal stimulus. Policymakers clearly recognize as well that stimulus interacts across countries. So the policymakers in one country are interested in stimulus occurring in the other country. And in fact, they potentially have a lot of interest in that because of course, they don't pay for the stimulus in the other country. For the stimulus in one's own country, you obviously have to pay for it over the long run through the budget. So there was actually lots of disagreement about this in the spring in the G20. I think some of the disagreement had to do with differences in political philosophy, because obviously some governments have obviously different countries will have governments of a variety of different political philosophies, and I think that was at the core of some of the disagreement. I think some of it also reflects different baseline debt levels. So the U.S. started with a relatively low debt level compared to some of the other countries, and therefore having a relatively greater ability to put on stimulus and sustain the incremental debt. Well, in fact, several European countries, and they're euphemistically called pigs, and they're called this, I think, for a number of different reasons, but one of which is that they include Portugal, Greece, Spain, and I'm not sure about the I. A lot of candidates, Italy, Ireland, Iceland. I don't quite remember which it is. But a lot of these countries, they have debt that's actually not that highly regarded in the marketplace. And actually the market pricing is not showing, I think, even the full difference, because there's kind of the market views Germany as providing implicit support for the debt. That is, there's a kind of a lot of innuendo that Germany maybe would bail out some of this other debt because Germany doesn't want other countries on the euro to go bad. It's a little bit like an argument that my colleague Dennis Eppel and I worked on a long time ago, that states in the U.S. kind of implicitly guarantee that states in the U.S. implicitly guarantee the debt of the localities within their state, even though they don't formally do so. And I think the Germans may have felt in the same place. With respect to fiscal policy, by the way, I think it's even striking that with respect to these credit issues, even the United Kingdom was actually placed on the watch list by Moody's in the spring for the possibility of a downgrade in their credit rating. And this I think, points to the limitation of fiscal policy. Now, I have a little theoretical argument I want to sort of advance that's related to this. And my theoretical argument is it's a pretty simple one, but it goes like this. That think of there being two types of goods: the traditional goods, the private goods, and another set of goods called public goods. And public goods are things like a bridge or traffic light that everybody consumes at the same time. And what government spending does is basically it buys public goods, not private goods. And suppose that the public goods, like the private goods, are what economists call a normal good. Now, a normal good is one that you demand more of when you're wealthier. So most goods you would expect would be normal goods. You might think, well, what would be not a normal good? Well, a classic example that's sometimes offered is they said that in Ireland 2 centuries ago, that when people got wealthier, they didn't demand as many potatoes because they could afford other kinds of food to eat. So not every good is necessarily a normal good. But usually I think most of the things that are public goods, like different kinds of investments of infrastructure and the like, we usually would think of these things as normal goods. So now what we had last year was a reduction in wealth, and a reduction in wealth of about a third. And so what would you expect? Would you expect then that the demand for bridges would go up or would go down in the face of a reduction in wealth of a third? Well, I would suggest that it would go down. We had a huge shock to wealth. So hence, this suggests, I think, that the optimal level of government spending, from a demand point of view, not necessarily from a supply point of view, but from a demand point of view, might actually decline at lower wealth levels. So tax policy potentially should be very important for stimulation. So this perspective, it's a little distinct from the ones you read about more typically, which I'll either label the Keynesian perspective. That would be the one that we want to put sort of money out there because that money will get then spent by the recipient to get spent by others, et cetera, the sort of so-called Keynesian multiplier, or the supply side, a kind of incentive type argument. This argument is sort of slightly different. It's more about the value of the public good relative to the private good, and how, in effect, implicitly, probably the demand for both public goods and private goods are both contracting. And so as we think about how to stimulate, we sort of need to be at least somewhat respectful that the goods that we're actually purchasing are the goods that are valuable, that are going to be valuable given the new circumstances. Financial institutions. So financial institutions are clearly going to be central to some of the conversation in the G20. It's interesting, countries tend to be pretty protective of their home country banks. This is illustrated, of course, by some of the bailouts by the Federal Reserve in the U.S. It's illustrated by bailouts worldwide. I mentioned before the $60 billion infusion of the Swiss government into UBS. And basically there's a big concern that large and very interconnected institutions would impose huge costs were they to fail. And a lot of observers are now pointing to Lehman Brothers and its failure as kind of illustrative of what some of those costs were. In fact, I think part of why Lehman was permitted to fail is that the Treasury at the time felt that it was important to create some market discipline. And so they let Lehman Brothers fail. But the problem is that letting Lehman Brothers fail may have actually reduced market discipline rather than increased it, because then most observers thought that everything in sight was going to have to be guaranteed. And so it may have actually had kind of just the reverse effect. Now, a lot of the policymakers now are also emphasizing the importance of having viable procedures for closing down major institutions. And I think there's a concern by many policymakers that we simply don't have this in place. But I think, unfortunately, I don't think there's been a lot of forward progress on this. And there's a lot of interconnection in different countries' situations with respect to how these institutions work, and I think some potentially very important international issues. For example, the Lehman Brothers bankruptcy, I think, has proved to be so complicated, in part because lots of what Lehman Brothers was doing in the U.S. was actually then booked to Lehman Brothers United Kingdom. And there's significant differences in the bankruptcy codes in these two countries. One of the things I've only learned about quite recently was that the treatment of what are called repo transactions, which is sort of a major way in which Wall Street tends to fund itself by basically loaning out securities for cash on a secured basis. Well, the priority of repo, so in the case of the U.S., when the company goes bankrupt and you had a repo transaction, if you're on the other side, you simply hold the securities you have and you're done. Well, that's not how it works in the UK, apparently. And furthermore, some of the counterparties thought they had deals with U.S. Lehman Brothers. Well, their deals with U.S. Lehman Brothers turned out to be Lehman Brothers rebooked it over to UK Lehman Brothers. And so lots of litigation about this. Another issue in which international issue is very, very important, the size of institutions. And just in the last week, the Wall Street Journal has been reporting about a big disagreement between the U.S. and the Europeans. The Europeans would like to more explicitly try to limit the size of financial institutions. The U.S. is sort of more reluctant to do that. But I think this is really a potentially very significant issue. To some degree, we see now the huge cost. I mean, traditionally the argument has been, well, whatever scale economies there are, we ought to let these firms exploit the scale economies. But we've now learned that those scale economies are far from free. If we have to kind of step in the ways that we did, and if our willingness to step in those ways then actually exacerbates the problem, because it leads then to a lot of risk, a lot of taking of risk. After all, if you're running a financial institution, and if it's hedge you win and tails the taxpayer loses, what are your incentives? In fact, in the words of my colleague Alan, of our distinguished faculty member Alan Meltzer, if you're too big to fail, then you're just too big. And I think this is a philosophy that the Europeans, some of the key European countries now have evolved to, but I think the U.S. is not at all there. I also think another way to tackle these kind of issues, and it's clear that there are going to be pretty strong disagreements about this at the upcoming meeting, I think the use of reserve requirements and fees. specifically having differential requirements for large institutions as opposed to small would potentially make a lot of sense. Compensation's been a huge issue, and an issue on which there's big disagreement across the Atlantic. Now, of course, in many cases, compensation reflects short-term metrics, but this can induce a lot of risk-taking because it's not really focused upon what economists would think of as risk-adjusted profit. Instead, it's sort of more nominal or notional amount, a notional view of profit. Now, at least options and restricted stock are somewhat tied to future performance. Cash bonuses, there's really no tie at all. But it's also striking to me that when you talk to folks from the financial services firms, there's lots of focus by them on how they're paid, and how they're paid personally, and how they're paid, and how their firm is paid. Let me offer a contrast. When you talk to a surgeon, or even when you talk to certain types of attorneys, there's not so much of a focus upon how they're paid or how their firm is going to get paid. Now, they're going to get paid well, but that's not the point. The point is, at the core of many financial transactions is how the party that's arranging the transaction is going to be paid. Well, that suggests that maybe compensation, the structure of compensation, it does have some first-order effects. But compensation, it's a difficult issue. And part of what makes it difficult is how do you really engender, even at the CEO level, how do you get the CEO to internalize the franchise risk that some decisions might create? Because after all, even a CEO of a major company has only limited wealth compared to the amount of wealth at stake. So currently, there's a lot of conflict, I think, across the Atlantic between some of the European governments and the U.S. government about what to do about this. I think the U.S. attitude is relatively laissez-faire. And some of the European countries, particularly the French, maybe most aggressively the French, are sort of relatively interventionist with respect to this issue. Now, I think my own view is that the case for intervention is perhaps strongest on the form rather than the level of compensation, because I think it's the form that leads to a lot of the distortion. Not so much whether the person is paid $1 million or $5 million, but what are the marginal incentives that are being induced by the form of compensation? That seems to me really a key issue. And I think from a societal perspective, the case for intervention is strongest to the extent that what one is trying to do is trying to manage the cost of the safety net or the bailout, manage the cost of the potential bailouts down the road. That seems if there's any case for kind of intervention with respect to compensation practices, it seems to me it's the government providing the safety net that underlies the viability of these firms that has to be key to that. But I think the attitude of the Europeans probably goes well beyond that. And the attitude of the U.S. probably falls significantly short of that. The interventionist tone issue also is manifested in a recent proposal that's getting some traction in Europe for what's called a Tobin, a transaction tax on securities trading. Jim Tobin the late Jim Tobin was an illustrious macroeconomist based at Yale. But personally, I don't think this was one of his finer proposals. This is something he advocated about 25 years ago. And at the time, its fans included actually Joe Stiglitz and Larry Summers. Although at least Summers, I think, has been pretty quiet on this issue of late. The idea of this, of a tax on trading, is to view trading as at the heart of the problem. But I'm personally not persuaded that trading is really what's driving the problem. I think it's sort of other aspects of the risk management system that may be much more central. So I want to make a few comments about financial regulation. So there's been a lot of movement in the last year toward, instead of having derivatives contracts entered into bilaterally, to have them handled through clearinghouses, and in which one would basically deal with a central entity, and the central entity would stand in the middle of the transaction, and this would have potentially the effect of mitigating counterparty risk. It's sort of a complicated issue, but potentially it may limit somewhat the systemic risk. But I think one of the things that's striking when you think about it in an international context is that even having clearinghouses doesn't necessarily resolve all these problems, because in fact you may wind up with lots of different clearinghouses, and they still have to kind of fit together in the financial system. Now, one of the dimensions in which you have different clearinghouses is you might have one clearinghouse for credit default swaps, and another one for interest rate swaps, and another one for foreign exchange, et cetera. That's one dimension in which there might be a variety of clearinghouses. But a whole other dimension might be, well, the US might have a set of clearinghouses, and then the Brits might have their set of clearinghouses, and the Japanese might have theirs. And it could be that Goldman Sachs is long vis-a-vis Deutsche Bank in one clearinghouse, but short in another. And by having all these things diffused in the way they are, it actually may not achieve as much netting as sort of the advocates feel. I think another key issue in the international context with respect to regulation is the one I already spoke about involving insolvency resolution, and the Lehman Brothers example I think really points to here some of the difficulty and some of the inherent complexity. In the past, there's been a lot of interest, particularly a number of years ago, in the aftermath of Sarbanes-Oxley. There had been concern that the prior environment was leading to what was by some regulators called a race to the bottom. So the idea that countries' regulators would compete for business, like for foreign listings, for example, or for other types of business, by having a looser regulatory environment. Actually, it's kind of interesting that the Sarbanes-Oxley regulatory requirements, which were viewed as actually pretty restrictive in a lot of ways, it's now clear that those regulations, they were really all about things like Enron and WorldCom. But despite that, they had nothing to do, basically, with the type of crisis that we had in the latter part of the decade. This is one of the tricky issues in dealing with regulation. I think a lot of this discussion, a lot of what I've been saying, also points to the tricky role of national boundaries, and how obviously inherent in national boundaries, we need to have somewhat separate regimes, regulatory regimes, but that can create obviously lots of issues in its own right. And let me point to a simple example, kind of motivated by this being opening day of the football season. In the U.S., there's a lot of local governments. And a lot of these local governments would like to have a sports team, baseball team, football team, whatever. How do they compete? Well, one of the ways they compete is every 30 years or so, they get squeezed by the incumbent teams to build a new stadium. And basically, the way this works is the incumbent team gets some other jurisdiction to offer either to build a new one, or sometimes even better yet, to give them the use of a stadium that's already built and it has some good characteristics. And so what does this do? It squeezes the other team. But think about it. This is basically a situation in which regulators, in this case these governments, are basically competing with each other, and it's kind of an example of the race to the bottom. It's hard to imagine a society where if those types of expenditures were all determined, let's say at the federal level, where there would be any interest whatsoever in building all these types of stadiums. It's all simply kind of part of how in that case, the local jurisdictions are kind of dealing with each other. Well, similarly, regulation at times can work in that sort of way. Well, I think at this point, so I have some comments on my slide about credit ratings and the overall role of credit ratings in the international system, and then I have a final slide on how the financial institutions are likely to evolve. But I think with respect to kind of some of the core issues of the G20, I think this is probably a good introduction and summary. So let me just at this point stop and open it up to questions.
Going back to one of your slides earlier, I'm interested in the, unilateral approach of the protectionist philosophy towards markets and economies of different maturities. And how does the G20 feel about that? And how do you think that affects the last point there about caring about the welfare of the world, respective to their particular maturities?
Okay, so that's a very good question. So clearly now the G20 reflects a range of different countries. I mean, a lot of them are more toward the developed side, but there's a range of countries, including even some like Saudi Arabia, an important, obviously, oil-producing country. So there's a range of attitudes and philosophies. Well, I mean, certainly I think with respect to the issue of protectionism, there's some diversity in views. I think some countries are anxious. Some countries are relatively anxious to export their product and sort of see themselves primarily that way, and other countries less less oriented that way. In terms of the particulars, who's where on the spectrum. That's something that's a little bit hard for me as an outsider to sort out. But it is clear that there's a pretty big disagreement, and that the U.S. has kind of moved from very oriented toward free trade to being considerably less so, and it really being pushed in the context of a lot of these international meetings, being pushed on the issue of free trade.
I'm thinking it's really simple, since the central bank just sell the T-bill, treasury bill to the market, and then can get back the regulations. But there are a lot of different concerns. So my question is that what do you think about the different approaches to monetary policy to retreat from the economy? And another one is what's the concern about it?
Okay, well. So clearly, with respect to monetary policy, and I hadn't highlighted these in my comments, but clearly, with respect to monetary policy, there's been somewhat different philosophies again in different parts of the world. Now, I highlighted it in terms of fiscal policy, that the U.S. has been relatively more aggressive, but I think it's also fair to say that the U.S. has been relatively more aggressive with respect to monetary policy as well, as compared to many of the European countries. As an example. I think one of the real difficulties is we usually think of part of what happens when you cut interest rates is that it has consequences for your attracting flows. And in fact, in many cases, when you cut interest rates, actually money leaves your country because folks want to invest in higher yield currencies. Now, this context is a little bit different because it's been more of a global sort of situation. Many of the moves in the interest rates have been in relative tandem. Indeed, I think even back in, I think it was early 2008, Ben Bernanke led a coordinated set of rate cuts, coordinated around the globe. And the reason I think that they were coordinated was this basically allowed countries like the U.S. that wanted to be aggressive about this to not face the consequences of then the move in exchange rates that would have otherwise happened. So so I think that's a good example of the potential importance of coordination. And if I were to kind of emphasize one very broad theme, it's that coordination across countries potentially creates a lot of benefit, but it's certainly not a panacea because there may be real differences in local objectives.
Do you believe that with the amount that the central banks have put out as far as quantitative easing and increase their balance sheets, along with the maybe reticence of the American consumer to pull the world economy out of its slump with not coming back to demand as quickly, do you believe that there's any possibilities or potentials for deflationary pressures coming in the foreground as you start to see maybe some of the stimulus run out and some of these different attempts to be made to generate global demand?
Personally, I'm not very worried about I'm not very worried about deflation. I understand conceptually why deflation is a problem. Obviously, you certainly one doesn't want a situation in which there is significant amount of deflation, because that really brings brings an economy to a halt. Why? Because if you knew that by waiting a month, the price of everything would be down 1%, you'd earn huge returns just by not spending. And that really would drive economic activity out. And that's why policymakers are so fearful about deflation. Now, do I think we are at much risk of significant deflation? My view is absolutely not. You've got a situation in the U.S. with basically massive federal budget deficits, not very credible plan really for dealing with this, and I think as a result, a lot of observers are much more concerned about inflation, and I think increasingly, in fact, inflation-protected bonds as an asset class have been in fact getting a lot of attention. Now, I think that my understanding is that the Treasury is going to be increasing somewhat its issuances of these. I think that's kind of a good move. And in fact, I think it was sort of a necessary move. I think the Chinese pretty much. I've made some comments before about the Chinese. I think one of the things that, in fact, in private conversations that the Chinese insisted on was much greater issuance of inflation-protected bonds. They want to buy a bunch of that compared to the nominal bonds that they're buying. And I think what they feel is that by issuing more of those bonds, maybe the U.S. will take more seriously some of these issues. So if we go back to early May, there were these two columns in one day in the New York Times, one by my colleague Alan Meltzer and the other by Paul Krugman, and they had very different views about the likelihood of inflation and deflation. And I think on this issue I'm very much on Alan's side. And I think most, from my conversations with many finance faculty, many finance professors around the country, I think most are much more concerned about inflation. Not inflation over the next year, but about inflation down the road than they are about deflation.
Can you give some kind of broad context for understanding, you just mentioned sort of back conversations with China and things like that, for kind of understanding what types of levers these countries are going to be pulling against each other to try to get what they want?
Well, what kind of leverage? So, in the most specific case, the Chinese have a lot of leverage. Why? Because they're huge buyers of U.S. government bonds. Suppose they stop buying bonds, then the question is, what would then be the yields associated with those bonds? Well, I think most observers think if the Chinese were to stop buying, the yields would go up significantly. So the Chinese, certainly with respect to then the composition, whether the Chinese have leverage with respect to our deficit policy, that's a different issue. And maybe it's not clear that they have that much leverage on that, but maybe they have some. Well, they certainly can stop then buying the bonds. They may not have, their leverage may be a little bit limited though, frankly, because that could hurt, if they cause a dramatic increase in long-term interest rates in the US, that's going to dramatically decrease the value of their holdings. So that maybe arguably limits the leverage. But certainly on a margin like encouraging the US to issue more inflation-protected bonds, I think that's something that they probably have a lot of leverage about. Now, more generally, what is the leverage that countries have with each other? Well, there's lots of different dimensions in which coordination and cooperation can be beneficial. And I pointed to a number of these types of dimensions. Now, there's a lot of issues where there's sort of disagreement. But you could imagine, like in other situations of negotiation, there could be give and take, and if some things are relatively important to some countries and not so important to other countries, there may be, there could be then some agreements about how to move forward. At the same time, you would expect that on some matters, countries are likely to just agree to disagree.
And one of the biggest losers maybe from this crisis are the international corporate and government responsibility programs, especially in Africa, Latin American countries. How do you think the G20 will take this issue?
Well, so the G20, I had thought at the London meeting, the G20 made a substantial commitment. I thought on the order of $1 trillion, but a lot of people kind of sneered at that and were kind of wondering whether it would actually get funded. And I'm not quite sure where the funding of that actually stands. So I thought at the London meeting there was a significant commitment, but how that plays out remains. I think still. It's not clear to what extent those commitments are going to be delivered on. And if you think about my comments before about wealth effects and public goods, well, I think one of the unfortunate victims of this sort of situation, the dramatic reduction of wealth, may well be the support that developing countries achieve. Just like I think we found domestically that in a lot of contexts, charitable donations are way down in the current environment, or at least Now I think one sort of now a lot of the uncertainty is starting to kind of ease, and we're kind of adjusting in a way to kind of the lower wealth levels. But to some extent, it may take a while for these plans to get rejiggered. I would expect that this would be a significant issue that will be discussed at the G20, and it may be that they do a little. I would imagine that they might do a little internal report card with respect to how even the commitments that were made in London, to what extent they've been delivered on. That would seem to be a natural issue for follow-up.
There's been some proposals by heads of state among the BRIC countries, Brazil, Russia, India, China, that with the possibility of replacing the U.S. dollar as an international reserve currency. Do you think that is likely to be touched on very
soon? It's hard for me to have much perspective on that, specifically on the issue of whether it's going to be touched on in the meeting. Obviously, there's going to be lots of these meetings. These meetings involve 20 countries, but it's not just one. It's not just in the case of the United States. It's not just the president. There's a whole team, and the members of the team are meeting with their counterparts. And so, these issues, it's easy to imagine could come up at different levels. Now, whether that may have been more intended, kind of like some of the remarks of the Chinese, may be more intended to emphasize to the U.S. That the U.S. is simply not just the dominant player in the world and needs to be respectful for other countries, and that may be part. That would be my view of part of the reason that some of those things have kind of emerged so publicly.
I was actually hoping you might just spend a minute talking about the future of Basel II capital accord.
I'm sorry, the future?
The future of Basel II capital accords and the revision of that, and possibly where it is, the treatment of risk-based capital, and where that is on the priority list.
Yeah. So my comment, the things I had prepared about Basel II were more focused about issues about relying on credit ratings and some of the issues there. But let me sort of try to address it in the following way. I think a lot of observers now feel, in the aftermath of the crisis, that the risk-based capital framework was not very successful. It didn't capture risks in the right way, that there was excess reliance on ratings. There wasn't maybe it wasn't as much justification as would have been desired, and when those ratings proved to be wrong, this was a huge source of systemic risk in the economy. And so arguably, then the whole system for capital requirements internationally help kind of be a driver of systemic risk in the economy. So, with respect to reform, I think a lot of the critics of the Basel II framework, and there were critics before, by the way, but I think a lot of the criticism of the Basel II framework has really been criticism about not focusing more upon the role of leverage. leverage types of requirements, and that there may have been a kind of a false precision that was being conveyed by Basel II. I would also anticipate that the role of capital and the need for capital underlying these financial institutions is certainly now going to receive much more attention. It's at the same time, a lot of the reforms and proposed reforms that have been put in place are proposals that the major financial services firms are pretty comfortable with, and I think they've traditionally liked having the ability to lever up so much. Well, I think now we can kind of see why, because then if you put a safety net under it, it kind of greatly enhances the profitability on the upside at the taxpayer's expense on the downside. But I think in terms of what might substitute for Basel II, I guess I would look to things like greater reliance on perhaps leverage ratios, maybe greater reliance even, although this is heresy to some, perhaps even on things like credit default swap prices. It seems to me that looking to market prices potentially provides very useful information for assessing the riskiness of firms, and maybe provides arguably the most information. But I also recognize that you can't just simply look to those prices to kind of anchor the whole system off of, because obviously that would be very vulnerable to manipulation, and indeed it needs as input a regulatory framework that's anchored at least in some way.
I have one more question so that we have time for the next class.
I'm really more concerned about if we're actually, the G20 is actually focused on the right problem or the actual source of the problem, because it seems like it's more of a focus on regulation and policy, and if you design a prison, the prisoners are going to figure out how to break out of it. It's just inevitable. So should the real focus be on trying to change the inherent behavior of the participants, or as such as the people operating in it look for arbitrage and the greed that ensued, which led to all these things happening? Unless we change that inherent behavior, is any system or policy that we come up with, is it going to actually solve the problem?
Well, I guess it depends on what we sort of view as the problem. I mean, I think we do want to have a vibrant system for supporting the financing of enterprise. And I think arguably over a long period of time, our system of capital markets has done that. But I think also at the same time, policymakers are clearly very concerned about the fragility of the system, and that's really been driven home by the crisis. But I think at the same time, I expect that they're going to be talking about other dimensions as well. I mean, I for example, because of my own expertise, I focus on the economic and financial system, but I think the policymakers are going to be talking about issues of sustainability and green issues and environmental issues as well, and that this is sort of an appropriate forum for those kind of discussions. Well, thank you very much.